Hey everyone, and welcome to today's Explainer. Today, we're really stepping into the shoes of a legal practitioner to look at, well, the absolute lifeblood of any law firm, its financial accounting. And look, under the strict regulations of the Legal Practice Act, understanding exactly how money flows through your firm, it's not just good business, it is a legal imperative. Mishandling funds can literally cost you your license. So we're going to put on our accounting hats today to really master these foundational principles that keep a practice compliant, profitable, and totally above board.
All right, we have got a lot of ground to cover. First up, we'll dive into Unit 4, the Books of First Entry. Then we'll tackle the incredibly strict boundary between trust and business accounts. After that, in Unit 5, we'll organize that daily data into the ledgers. And finally, we'll wrap it all up with the financial statements. Let's dive right in.
Okay, let's dive into this. Unit 4, Books of First Entry. So, think of the Books of First Entry as your law firm's daily diary. It's literally right there in the name, it's where transactions are listed when they first occur. This is a chronological, everyday process. The second a source document is generated, like a receipt for a client payment or maybe an invoice for keeping the office lights on, it goes straight into this daily diary. And as a legal practitioner, you're not just doing this because it's highly recommended. You do it because Rule 54.6 of the Legal Practice Council flat out mandates that these day-to-day transaction records must be kept meticulously.
Now, while your average run-of-the-mill business just uses general cash journals, a law practice is a whole different ballgame. Because of the specific nature of legal work, law firms actually maintain specialized diaries or journals. For example, you've got a fees journal, and that's dedicated entirely to recording the fees levied for the services you've actually rendered to clients. But then you also have a sheriff's journal, which is used specifically to record the claims of sheriffs for services they've rendered on credit. And similarly, there's an advocate's journal to track claims from advocates. These highly specialized diaries make sure that every unique type of legal service or expense is perfectly categorized the very second it hits the firm.
Moving right along to a massive topic, trust versus business accounts.
Now, what's really interesting about this slide is the absolutely stark separation between these two worlds. I mean, it's a strict dichotomy. On one side, we have the business cash journals. These are tracking the flows of cash into and out of the firm's own business bank account. This is the firm's money, right? It's used to pay rent, buy office supplies, distribute profits, all that stuff. But on the other side, completely walled off, are the trust cash journals. These track the cash flowing into and out of the trust bank account. This is money being held on behalf of clients. Commingling these two, like accidentally paying the firm's electricity bill from the trust account or depositing a client's settlement into the business account, that is the ultimate pitfall in legal accounting. It's a massive breach of compliance.
Okay, time for a quick, energetic pop quiz just to make sure this concept is totally cemented in our minds. This is pulled directly from the self-assessment exercises in our source material. Ask yourself, are trust funds the property of the legal practitioner? The answer is a resounding, unambiguous no. No way. Trust money belongs solely to the client or the third party you're holding it for, period. You are merely the custodian. Keeping those books of first entry perfectly separated into trust and business journals, that is exactly how you prove to the Legal Practice Council that you respect that boundary.
All right, let's transition over to Unit 5, the ledgers. So if the books of first entry are your chronological diary, the ledgers are the firm's organized filing cabinets. Let's move to and see how this builds across the entire accounting cycle. We always start with the source document. That's your raw evidence. Step 2, as we just learned, is entering that evidence chronologically into the journal. But honestly, a chronological list isn't very helpful if you want to know exactly how much you spent on printing this entire year, right? So in Step 3, we take that daily data and post it into the general ledger. From there, we verify our math in Step 4 with a trial balance, and that perfectly sets up our final product in Step 5, the financial statements.
You can really think of the general ledger as the master filing cabinet. All those kind of chaotic daily journal entries we just talked about get sorted here into clean, logical categories: assets, liabilities, and capital. So if you ever need to know the total balance of your business bank account or exactly how much capital the partners have invested, you just pull open that specific drawer in the general ledger. It literally turns raw daily data into usable, highly organized information. And that brings us to our final destination on this journey, the financial statements.
The financial statements are essentially the firm's end-of-year report card. This is how a business formally communicates its financial results. And there are 5 main components we look at here. The statement of profit or loss simply tells us, well, did the firm make money? The statement of changes in equity tracks what the owners actually put in or took out.
The statement of financial position lists exactly what the firm owns versus what it owes. The statement of cash flows shows the literal, actual cash moving in and out. And finally, the notes to the financial statements, these provide all the vital written context in the accounting policies that numbers alone just can't explain.
Let's zoom in specifically on the statement of financial position, which you might know by its older name, the balance sheet. It's the ultimate snapshot. It reports on the assets, liabilities, and equity of the entity at a very specific moment in time. But the absolutely crucial point here is that this entire snapshot is built on one foundational accounting equation: assets equal liabilities plus equity. It's this perfect balancing act. But remember, it relies entirely on the accuracy of the ledgers and journals that preceded it.
So, as we wrap up this explainer, I want to leave you with a bit of a provocative thought to reflect on. How could a single misplaced zero in your daily diary, your books of first entry, completely alter your firm's final report card? Think about that ripple effect. A tiny innocent error at the very beginning flows right into the ledgers, throws off the trial balance, skews the financial statements, and in a law firm could accidentally blur the lines between business and trust funds. It is a powerful reminder that absolute precision at step one is the true foundation of your entire practice. Thanks so much for joining me today, and keep learning.